Welcome to the FMLS Market Intel Report. I'm Leslie Appleton-Young, Chief Economist for FMLS. 2 weeks ago, the big news was the much-anticipated quarter-point cut in the Fed funds rate. Since then, mortgage rates have actually gone up a bit. That's right. Freddie Mac reported an average of 6.3% for the week ending September 25th, up from 6.26% the week before. What happened? Quite simply, the market got what they expected, and that expectation had already driven rates down. Investors had been pricing the impact of the lower Fed funds rate into the bond market for weeks, so there wasn't ever going to be a big reaction to the actual cut. Mortgage rates are closely tied to the 10-year Treasury yield. The spread between the two is the risk premium demanded by investors to loan funds to homeowners via mortgage-backed securities. So what's the bond market got to do with it? Everything. The Fed funds rate is short-term. It's the rate the Fed charges for banks to borrow overnight to meet their reserve requirements. It indirectly impacts longer-term rates depending on how investors view the future. If a cut is expected and investors view this as supporting stronger economic growth, the 10-year Treasury and the 30-year fixed-rate mortgage will drop. But if the cut is viewed as likely to fuel inflation, longer-term rates will be pushed up as investors demand a higher rate of return. This gets to the heart of why future Fed cuts and the direction of mortgage rates remains so uncertain. The Fed has a dual mandate to maintain a strong labor market and low inflation. Right now, the labor market is weakening. At the same time, inflation is above the 2% target and accelerating. With no discernible risk-free path, the Fed's cut is a step towards a more neutral policy stance, but with little certainty of the timing of future cuts. By the Fed's next meeting at the end of October, they will have the September jobs report, which comes out on October 3rd, and the CPI report on October 15th. If the labor market continues to weaken and inflation holds steady, expect a cut. If inflation accelerates and the jobs numbers improve, a cut is less likely. The Fed's actions going forward will be both data-determined and a toss-up. There is not a policy consensus on the board, which remains sharply divided. As Chairman Powell noted last week, it's challenging to know what to do. What about the housing market? With rates in the low sixes, home buyers who have been on the sidelines should be encouraged. What's more, Realtor.com's recent report on the best time to buy found that nationwide, October 12th through 18th is the best week to buy all year. For the Atlanta, Sandy Springs, Roswell metro area, it's September 28th through October 4th. Here's how they broke down their analysis. First, higher inventory. Listings typically peak in early fall, and this week is projected to have the most active listings of the year, providing more options for buyers. Second, lower prices. Listing prices are, on average, lower than their seasonal peaks, potentially offering significant savings on a median-priced home. Third, less competition. Buyer demand has softened due to affordability challenges and higher mortgage rates, leading to less competition. More price reductions. This period historically sees a higher percentage of price cuts on homes, giving buyers more room for negotiation. And finally, a slower market pace. Homes are taking longer to sell, giving buyers more time to consider their options and make decisions. In other words, this is the best time all year to be in the market for a home. Don't miss it. Take a look at market intel on the FMLS website to access the most current market statistics. They are updated weekly. If you're interested in resources relative to our market dynamics and want to dive into local markets, we've got you covered. For FMLS Market Intel, this is Leslie Appleton-Young. See you next time.